Hi everyone, welcome back. Before we begin, just a quick disclaimer. This video is for educational and research purposes only. It does not constitute financial advice or an investment recommendation. All strategies shown here are hypothetical and based on historical data. Past performance does not guarantee future results. Please do your own research before making any investment decision. Financial markets are complex and constantly evolving systems where risk and return dynamics change over time. In recent years, advances in data science and machine learning have made it possible to design investment strategies that dynamically respond to changing market conditions. These approaches aim to identify patterns in financial data and adjust portfolio allocation accordingly. In this notebook, we develop a simple adaptive investment strategy that combines three important ideas from quantitative finance. 1. Market regime detection using a hidden Markov model, which attempts to identify different states of the market such as low volatility, high volatility, or transitional regimes. 2. Factor-based investing, using a momentum signal to rank assets based on their recent performance. 3. Dynamic asset allocation, where portfolio weights change depending on both the detected market regime and the relative strength of each asset. Data collection. We begin by downloading historical price data for a small multi-asset universe. The dataset includes 4 widely traded exchange trade funds representing different asset classes. SPY ETF tracking the S&P 500 index, QQQ ETF tracking the Nasdaq 100 index, TLT ETF tracking long-term US Treasury bonds, GLD ETF tracking the price of gold. These assets provide exposure to equities, fixed income, and commodities, allowing the strategy to capture potential rotation across major macroeconomic regimes. The figure above shows the historical price evolution of the asset included in this study. Several patterns can be observed. Equity ETF such as SPY and QQQ exhibit a strong long-term upward trend. QQQ shows faster growth, reflecting the strong performance of the technology sector. TLT displays a different dynamic, influenced by change in the interest rate environment. GLD exhibits periods of strong appreciation during times of market uncertainty. The differences in behavior across these assets suggest that diversification across asset classes may help capture different market environments. These structural differences also motivate the use of regime switching models to identify shifts in market dynamics. The chart above shows the market regimes detected by the Hidden Markov Model. Each point represents the price of SPY, the S&P 500 ETF, and the color indicates the regime inferred by the model at that moment in the time. The model identifies three hidden states, which correspond to different statistical behaviors of the market. These regimes can often be interpreted as Regime 0, period of stable market growth and relative low volatility. Regime 1, transitional market phases or moderate volatility. Regime 2, period of market stress, higher volatility or correction. It is important to note that the HMM does not know economic concepts such as bull markets or bear markets. Instead, it detects statistically distinct patterns in the data, which we later interpret as different market environments. This type of regime detection is widely used in quantitative finance to improve portfolio allocation, risk management, and trading strategies. Adaptive AI strategy versus benchmark. The chart above compares the cumulative performance of the adaptive strategy with a simple buy and hold investment in SPY. The results show that the adaptive strategy slightly outperforms the benchmark over the full sample period. This performance improvement arises from two key mechanisms. One, regime awareness. The portfolio adjusts its base allocation depending on market regime detected by the Hidden Markov Model. 2. Momentum tilting. Asset weights are adjusted toward assets with stronger recent performance. By combining regime detection with factor-based allocation, the strategy attempts to adapt dynamically to changing market conditions. Although the results are encouraging, this example should be interpreted as a simplified educational demonstration rather than a fully production-ready trading system. Performance and evaluation. To evaluate the strategy, we compute three standard performance metrics: annualized return, annualized volatility, Sharpe ratio. Annualization assumes 252 trading days per year. The Sharpe ratio measures risk-adjusted performance and is defined as Sharpe equal annual return divided by annual volatility. Performance evaluation. Adaptive AI strategy. Annual return 14.45%. Volatility 11.74%. Sharpe ratio 1.23. Benchmark SPY annual return 14.18%. Volatility 17.20%. Sharpe ratio 0.82. The adaptive strategy achieves a similar return to the benchmark, but with substantially lower volatility. As a result, the risk-adjusted performance Sharpe ratio is significantly higher. Rolling Sharp Ratio. To better understand how the strategy performs through time, we compute a rolling Sharp ratio using 252-day window, approximately one trading year. This metric shows how the risk-adjusted performance of the strategy evolves over the time. Several observations can be made from the chart. The strategy spans long periods with a Sharp ratio above 1, indicating a strong risk-adjusted performance. There are occasional periods where the Sharp ratio becomes negative, which is expected during difficult market environments or rapid regime changes. During favorable market conditions, the Sharp ratio can exceed 2 or even 3, suggesting the strategy is well aligned with prevailing market trends. Overall, the rolling analysis shows that the strategy's performance is not concentrated in a single period, but instead appears across multiple market environments. Strategy drawdown. Drawdown measures the decline of a portfolio from its historical peak. This metric helps evaluate the downside risk of the strategy. From the chart, we observe that the strategy experienced several temporary drawdowns, which are normal for any investment strategy. The maximum drawdown appears to be around minus 20% to minus 22%. Compared to many equity-based strategies, this level of drawdown is moderate and indicates relatively good risk control. The strategy is also able to recover from drawdowns and reach new equity highs over time, suggesting a degree of robustness across different market environments. Conclusion. In this notebook, we develop a simple adaptive investment strategy that combines machine learning techniques with factor-based portfolio allocation. The approach integrates three main components: market regime detection using Hidden Markov Model to identify different market environments, factor-based asset selection using momentum as a signal to tilt portfolio weights toward stronger assets, dynamic portfolio allocation, where base asset weights change depending on the detected market regime and are further adjusted by factor signals. The backtest results show that the adaptive strategy achieves a return similar to the benchmark while significantly reducing volatility. As a result, the strategy delivers a higher risk-adjusted performance as measured by the Sharp ratio. Additional diagnostics such as the rolling Sharp ratio and the drawdown analysis indicate that the strategy performs consistently across multiple market environments and maintains a reasonable level of downside risk. It is important to emphasize that this notebook is intended as an educational demonstration of how data science and machine learning techniques can be applied to portfolio management. In practice, further work will be required, including transaction cost modeling, out-of-sample testing, and robustness analysis. Nevertheless, this example illustrates how combining regime detection, factor investing, and adaptive allocation can lead to more robust investment strategies in changing market conditions. Thank you for watching this video. See you in the next video.